Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stops. We get you in-depth analysis, deep dive into financials, but we also highlight all the key risks and triggers going forward. Well, let's get straight to the first stock that we have on our radar. My colleague Sonal gets us this very special deep dive on CEAT.
We are here at the headquarters of CEAT's office in Mumbai, a leading manufacturer of tires in the country. The company has 6 manufacturing facilities at Nagpur, Nasik, Halol, Chennai, Ambernath and Bhandup. Now, in terms of their product mix, around 30% revenues coming from the trucks and buses segments, there are 26% from 2 or 3 wheelers, 8% from light commercial vehicles, 20% from passenger cars, and 16% coming from the off-highway segment. Now, in terms of their segments and the end market, 56% comes from replacement market, 31% from original equipment manufacturers, and the rest comes in from export markets. Let's talk about their financial performance now. FY23 ended on a good note. Their FY23 revenues stood at 11,600 crore rupees and they have been consistently increasing from levels of 7,000 crores in FY19. EBITDA margins, however, they saw a decline post stellar numbers that the company saw in FY21 due to higher costs. But in FY23, the company was able to make a recovery and margins came in higher as well at 8.7%. Profits also, after seeing a dip in FY22 due to a lot of macro issues and raw material costs as well, did see a recovery in FY23 to levels of 182 crore rupees. The debt of the company stands at 2,093 crore rupees. This was the year when capex of the company was around 900 crore rupees. Going forward, they expect capex of around 700 to 750 crore rupees. Company says FY24 demand looks good in terms of OEM segment, and while exports might be muted in the near term, recovery is expected in second half of FY24. Also, they expect replacement growth to be in high single digits across all the segments, be it commercial vehicles, passenger vehicles or two-wheeler segment as well. The company now has a new leadership at the helm after Mr. Anand Banerjee stepped down as the CEO. Mr. Arnab Banerjee has taken over as the CEO. So let's speak to him to understand his strategy and take a deep dive into the business of CEAT. Into CEAT's business, and we have with us the CEO and MD of the company, Mr. Arnab Banerjee. Mr. Banerjee, thank you so much for joining us here on Inside Out in CNBC-TV18. On the show, we try to take a deep dive and understand the company's business. So before I get into the financials, the outlook, the strategy, from a tires manufacturer's perspective, can you tell us what is the most important thing in the value chain? What do you have to manage the best? Is it the supply side, the raw material pricing? Is it the distribution, or focusing on high margin product for you and generally the industry as well?
Right. For us, I can say that we get clubbed as one of the manufacturing companies, as you just said. But I would like to believe that we are a B2C company, really, and it's all about our customers. Our focus also has been in the recent times in the passenger segments, right? So it starts with the customer interface, understanding their needs, what do we have to improve and what new we have to bring in. It starts from there, and all our margins and capex, etc. will follow from there, right? If you don't succeed there, then nothing happens. Now, coming back to the brass tacks of the manufacturing part, which is what we started off with. So, it's a it's a capex intensive industry. So, and the asset turnover ratio is moderate. So, for every 1,000 crore, we get about 1,200-1,300 crores of turnover. So we are at 11,000 crore company. So, to grow by 10%, every year we have to invest about 1,000 crores. Not now, because we have a lot of headroom in terms of capex, which has just ended the capex cycle. So we can easily grow, let's say, up to 14,000 crore into 3 years. So it's not required immediately, but you get the picture. To grow 10%, we need to have capex of about 1,000 crores every year, right? So that's important. Management of capex, phasing out of capex, and it's doing in the right segments where we can quickly ramp up capacity, where we have brand strength, which is the passenger side.
Okay. So, yeah. All right. So those are a lot of numbers. 1.2 times is the asset turn in the industry overall.
1.2, 1.3.
1.3. Right. So last time you spoke about how capex is mostly over in the recent times. The next capex will take some time, of course. But when you talk about focusing on segments which are profitable, you have 1.4 lakh production capacity on a per day basis. With the capex which is coming in, how much will it increase to, and how is it split between different segments?
Yeah, so as you said, the capex cycle has ended. This year we will have hardly about around 700 crores of capex, out of which 500 crores is the tail end of previous capex. So we had a lot of bunching in the past of 3,000 crores. So right now, whether it's two-wheelers or passenger cars or truck bus radials, we have a lot of headroom in terms of operating leverage. We can grow, as I said, to 14,000 crores for next 2 years or so. So no huge capex is required as of now or in the next financial year, not a huge number. So the focus is on the most profitable segment, which is agriculture radial, and their capex is going on out of that 700 crore. We're expanding our Ambernath plant. We have reached about, let's say, 100 odd tons per day, and we plan to reach by next financial year about 150 tons per day. So that's the most profitable part of our business where capex is going on.
Okay, so agricultural radial tires, that's
Right.
the most profitable part. When we talk about your market share across segments, as you said, one of them is the most profitable, but again, PV continues to be the focus
Right.
point itself.
Right.
How do you see market share panning out? And when we talk about competitive intensity in the industry as well, what is the plan to grow that market share?
Right. So our focus is, apart from agri radials, which is mostly in the international markets, domestic market, we are a passenger-focused B2C company. So we are market leaders in motorcycle and scooter tires, as you know. We are roughly about 1/3 of the market with us. So it's a huge dominant market share. And we intend to grow it gradually to about 37-38% and closer to 40% over the year. So how will that come is because CEAT is a preferred brand amongst consumers, and we have a unique distribution structure which is akin to the FMCG distribution style, and that's a unique DNA of the CEAT two-wheeler business, right? And our margins are good. So we can pump resources continuously to grow the two-wheeler segment. Coming to passenger segment, competitive intensity is high. There are 7-8 strong players there. And if I look back, let's say 10-12 years back, when we had only a little bit of production in the Nashik plant, Halol was not fully in production, we had 2.5% share, 2.5 only. So we have come a long way. We are at about 15-16% share today. And because it's a 8-cornered race, we happen to be a close number 3 already. So a little bit of improvement, let's say about 2.5-3%, would take us to market leadership, which is what we are chasing in the next 2 to 3 years.
Let's talk about the tire industry in general.
Yes.
When we talk about higher dumping coming in from other competitors globally, is that something that happens? How do you manage the raw material side? Because we do know that tire prices, they keep fluctuating, crude prices, they keep fluctuating. In that case, what's your strategy on the sourcing side?
You mean raw material?
Yes, raw material.
So raw material is a global supply chain for the entire industry, right? And if you start with natural rubber, about 40-45% is sourced domestically, or 50%, and 50% is sourced globally. And new sources are coming up as well. So we are continuously on the lookout of new sources which satisfy our specifications and quality requirements and do that. Similarly, non-rubber also is a global supply chain, and there are a lot of opportunities, and we continuously develop new sources. Let's say in China, even Russia, and in Europe we have sources, and of course in India. So with focus on sustainability, the customer requirements are changing, and more sustainable materials have now to get into the rubber, into the tire for processing. So these are new areas for us to work, and completely new knowledge creation for which we need new suppliers. Many of them are global. So
a lot of companies are speaking about the sustainability bit. What I wanted to understand is, when you're talking about sourcing in green terms and selling green products as well, does it make it more expensive?
That's the catch. So sustainability and business fundamentals have to go hand in hand. So far it has. So it's not really a big surprise, but it's about learning how to inculcate new raw materials into our tires, how to process them without loss of capacity at a price at which the customer will buy. right?
Exactly.
So that's the challenge for the industry and for us. I think we are investing a lot of time, resource and money.
Okay, so that is a key to track generally across the industry as well,
Right.
when they are getting into this newer sourcing and supply of products as well. You spoke about agricultural radial tires being the most profitable business. It's mostly in export markets.
Mostly,
but export markets have been on the weaker side for a while now. And I was hearing your earlier commentary. You said export markets will be a focus as well.
Yes.
How do you plan to do that? How do you tap export customers? Because even in global markets, we do have a lot of competition.
Yes, we do. I mean, everywhere it is competitive, and specifically for agri-radial and also including passenger and truck bus radial, we are at about 17-18% saliency of international business today, right? In the next 3 years, we would like to take it to about 25% of our turnover. There are many advantages apart from it being margin accretive. We learn new stuff, and when we learn new stuff, because the global customer is much more challenging, it's much more competitive, we can always bring those learnings and stay ahead of competition in the domestic market. So current situation is a mixed situation. There are recessionary headwinds in Europe and somewhat in US, not so much. India is doing well. We don't have any business in China per se. So Europe and US and then Latin America is doing pretty okay, right?
Okay. So the new segment that you got into, I think 4 or 5 years back or 6 years back, was off-highway tires.
Yeah.
What was the strategy behind that? What prompted that? And how is that business doing? Is it a high growth business and there are still triggers going ahead in this particular segment?
See, we have had a old history of a very small sliver of our business in off-highway, which was primarily bias off-highway tire, which was used mostly in ports. So that was there for 2-3 decades with us. So we were in the market, but we're not focusing there. We didn't grow, but it was always high margin. Now the expansion is primarily in agri-radial, which is also off-highway. So when we say off-highway, it is both in bias off-highway, which is going into ports, mining, etc., and agri-radial. So agri-radial is a fresh new plant at Ambernath, which is really the fastest growing part. We are growing last 3 to 5 years about 25% CAGR is the most profitable part, and we intend to keep a very aggressive growth rate in agri-radial, also in bias off-highway, which goes into mining and ports.
Big segment that is gaining a lot of popularity is the EV segment. Are tires needed in the EV segment different? Are they higher margin? How does it work for that particular market from your perspective?
Yeah, the tires are completely different. It looks the same, but it's completely different because the battery is there. It's a heavy item. So when you start the car, it requires a lot of traction. That's one. So compounding is totally different. The patterns are different. Then in EV, there are no moving parts. So the entire noise will come from the tire. So you need to have an absolutely noiseless sort of tire. Okay? And then you have range anxiety when battery will run out. So for that, the friction needs to be modulated in such a way so that it burns less energy and the battery lasts longer. So these are the three amongst many other design requirements. It looks the same, but it's completely different tire.
And the production costs are also higher here. How does the market work towards in the aftermarket, I would say? And what is the outlook on EV segment? Have you already started being in conversations with 2-wheelers, 3-wheelers, already supplying? Will it be a bigger pie going forward?
Yeah. I think it's a secular trend which is going to strengthen in the future. So in 2-wheelers, if you find already 15 to 20% of the OEM production is EVs, including startups and the big players, right? And we have taken a good position there, about 40% plus share we've already got in that segment, and it will keep going up, and we need to do that because 1/3 of the replacement market is with us. So in an emerging trend, we'd like to take a higher stake. In 4-wheelers also, what I read is about 30-35% of the vehicles on the road will become EV by 2030. I don't know whether it will happen, but it will generally move in that direction. Right now, I think about 1.5-2% of the new cars are EV, mostly 1 or 2 models which you're aware of. We have started working with OEMs. We have started getting their RFQs and getting nominated into their EV projects. So very strong R&D work has already happened, including our Frankfurt station for the materials. And coming to your previous question, whether it requires different kind of production techniques, not really, but the cost is different, and therefore the challenge in the learning how to bring it back to the same cost structure so that the customer doesn't have to pay super premium on the tires.
Okay, so around 2,100 crore rupees is the debt right now. What are the debt levels you're comfortable with in terms of net debt to equity also?
Debt equity is very sober at 0.6 or something, and debt EBITDA, which is what we track, is about 2.1 as you've seen. So we're comfortable with that. I mean, we even during COVID time, we were worried that we will cross 3:1, but we managed to just about touch that kind of level and come back to 2.1. So if you do bite-sized capex, as I said, going along, I don't think that will be stressful.
Okay, I was just doing some number crunching, and how have tire stocks performed in last couple of years, a decade so to say. So I was just looking at CEAT 2000%. The stock price is higher by that much in last 10 years. So definitely a growth story here. But say next 5 to 10 years down the line, you have come as the CEO now. Any strategy changes you're looking at? What is the 5-year plan? What would your focus point be?
So as an outcome, we are looking at two things which we are aligned on. Both are external facing. One is market cap. Okay, we don't make market cap happen, but because of what we do, that's a reward that the company gets, and market shares. So these are the two outcomes which is top in terms of visibility across the organization. Now there is a clutch of things that will develop market share and market cap, right? On the financial side as well as in the operation side. So we have got that completely tabulated, and we know exactly what levers to press at what time to make those things happen. So in terms of strategy, internationalization, riding a trend which is EV is the hottest trend now, and in terms of margin accretion, so that our capex is continuously well funded, agri-radial, two-wheeler, passengers. That is the sequence, right? And we will continue to maintain that sequence. We'll continue to avoid bunching and have bite-sized capex and quick ramp-ups that will impact ROC, which impacts market cap.
Okay, all right, Mr. Banerjee, it was such an interesting chat. Thank you so much for a deep dive into your business and explaining to us that yes, the focus is customer, and explaining the entire value chain as well. It was a pleasure speaking with you today.
Thank you very much.
All right, with that, it's a wrap on this segment of Deep Dive. Back to you in the studios.
All right, that was a deep dive into CEAT, but it's time for us to slip into a short break. We come back with another interesting stock. Skipper Limited is the stock on our Swotlight segment. Don't go anywhere. See you on the other side. Welcome back. You're tuned into Inside Out. Well, the stock on our Swotlight segment is Skipper Limited. The company has three broad segments, namely manufacturing for transmission and distribution structures, which consist of power transmission towers, power distribution poles, and telecom towers, among others. They also have a small but growing brand in the polymer segment. That includes UPVC pipes, CPVC pipes, and HDPE pipes. Smallest part of their business is infra projects. That includes transmission line EPC, telecom EPC, railway electrification, and water EPC. Now the quarterly performance, well, it's improving. And in Q4 FY23, they delivered their best revenues, which exceeded 650 crores odd, with both the engineering and the polymer products business growing in excess of 20%. The margins as well, they've been steadily improving on a quarter-to-quarter basis all of FY23. Now over the last few years, well, growth has been a little bit disappointing. It hasn't been great really, but the management has indicated from year on they intend to grow by 25 to 30% for the next 3 years. Vertical wise, well, let's give you a little bit more clarity on the revenue breakup between segments. The engineering products business, well, that's the largest revenue contributor with the best margins at around 12.8%. The management says there is scope for the overall margins to get even better from year on the back of better quality contracts and increased share of engineering export business. This will be further aided by the polymer segment as it attains scale and size, which will be benefited from fixed costs getting rationalized over a larger revenue base. The management says that they also position to grow exports from the existing 50% of engineering revenue in FY23 to around 75% in the next few years. Now, the year-end closing order book for the company was around 4,500 crores odd. That's the highest ever in the history for the company, of which exports accounted for around 20%, and the share of non-T&D products, including railways and telecoms, that increased to around 62%. But this is higher as they secured a single largest order win of around 2,500 crores from BSNL during FY23. Additionally, the company is actively pursuing projects worth around 6,600 crore rupees, that's on the international business front, and around 3,500 crores domestically. And in the past month itself, they won orders to the tune of more than 1,135 crores from both domestic and the international market. Well, in FY23, the company made the right moves on the balance sheet as well. The total debt, well, it reduced a little bit. That's despite having higher sales. This was primarily on account of better working capital utilization and better collection from debtors. Well, let's wind this down with the shareholding pattern and the valuations. With regard to the shareholding pattern, well, the promoter entity holds close to around 72% stake in the company, and you have FIs that own close to around 9.5%. While even if you analyze its healthy Q4 FY23 numbers, it's trading at around 16.5 to around 17 times. So the company will have to deliver something phenomenal from here on to justify this recent run-up in the stock. The big question is, how much of it is in the price? Well, this completely run out of time on this edition of Inside Out. It's goodbye from Sonal and myself, but you do write to us and tell us about companies you want to discuss and you want to hear about. We'll try to feature them on the show. Thanks so much for watching.